Hello and welcome to Gold and Silver Assets. I'm Diora and it's Sunday the 2nd of May 2021. Could silver be worth as much as gold? Now some might say this is a completely preposterous notion, but believe it or not, there have actually been episodes in history where such a thing has occurred. So it's really not impossible. So here we're talking about the gold-silver ratio being historically low. Could such a low ratio occur again? And if so, what are the factors that could cause it to occur? When it comes to the gold-silver ratio, the first thing we need to clarify is which specific ratio we're talking about. Within the Earth, silver is 19 times more prevalent than gold. However, when it comes to extracting the metals, 9 times more silver is mined than gold. Now, these ratios are relatively static, but when it comes to pricing, two ratios exist, and these are actually dynamic. The physical price ratio is currently around 55. But of course, when people are talking about the gold-silver ratio, they're usually referring to the paper price ratio, which is currently around 66. And it's this ratio that I'm going to be discussing here. Looking at the history of this ratio can be informative, and we can divide it into four main eras. We can see that during the bimetallic standard, when both gold and silver were considered monetary metals, the ratio was very stable, averaging 15. The demonetisation of silver in 1873 saw a rise in the ratio with an average value of 30. The end of the classical gold standard saw a huge fluctuation in the gold-silver ratio with a range of 17 to 97. And then the fiat era has seen even larger swings in the ratio from 15 to 120. Let's have a closer look at those swings in the fiat era. This chart shows that in the fiat era there are two sub-eras, so one over here and one over here. And within those eras, the ratio appears to swing up and down between a roof and a floor. So in the inflationary 1970s here, the ratio moved between 18 and 48. But from around 1990 to today, the ratio has mainly swung between a floor of 45 and a roof of around 80. If we look more closely, we can see that it's taken between around 2 to 5 years for the ratio to go from its maximum peak to its ultimate trough. Here, 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 and here, shown in red. We can also see that there are numerous upswings on the way down, and the majority of time is spent in the mid-range. Also, times at the peak and trough values are usually quite brief, so they kind of spike up or down. So what's the ratio telling us right now? Well, the first thing to note here is that last year the ratio reached a historical extreme high, and it's since dropped very rapidly towards the mean. In fact, it's been one of the fastest declines, and the ratio clearly remains in a downtrend. So history suggests that it's likely to spend more time in this area between 50 and 70 before spiking down to its ultimate low. But the question is, where will that ultimate low be? And also, how long will it take to reach its ultimate low? This leads us to the question of how low the gold-silver ratio could go. The previous chart shows that it's likely to drop at least to 55, but could it drop significantly lower? Could it break that floor in a meaningful way? Now, in order to answer this, we really need to understand what drives the gold-silver ratio. This chart shows the gold-silver ratio in black and the gold price here in orange. At the bottom, shown in red, is the correlation coefficient between these two values. And we can see that the correlation is rather variable. It flips between positive and negative. So that tells us that we're not really seeing any consistent relationship between gold price and the gold-silver ratio. However, When we compare the ratio with the silver price shown here in grey, the correlation is strongly negative most of the time. That's pretty obvious to see here. We can therefore conclude that the silver price is the predominant driver of the gold-silver ratio. A drop in the ratio is associated with a silver bull market. Now this chart shows how the peaks in the gold-silver ratio over here, here and here, as well as here, have marked the bottoms in silver bear markets. Also, lows in the ratio have marked the tops of silver bull markets. So we can see that over here and over here in particular. The fact that the ratio is currently moving downwards from a historical peak suggests that silver is in a secular bull market. Also note that over here, every time this correlation turns positive, now that's quite a rare event, and interestingly in the 70s it lasted for reasonable amounts of time and actually became relatively strongly positive, but since the 90s it's been rare, brief and very minor. But interestingly, every time this has turned positive, if you look at the grey line, you can see that that's marked the beginning of a large rise in the silver price. So that occurred here. We've got this positive thing here and it goes up. Again over here, that marked the bottom there and price shot up there. And interestingly, we had a similar signal last year, and that coincided with this point. And of course, we have seen a subsequent rise in silver, which I would expect to continue. So this supports the idea that silver has entered a silver bull market. Okay, now that we know that silver is the main driver of the gold-silver ratio, is it the industrial or monetary demand that primarily affects the silver price? This chart compares the Bloomberg Industrial Metals Index, drawn here in red, and the silver price, drawn here in grey. And below is shown the correlation coefficient between the two. And we can see that it's highly variable with big swings between positive and negative. Therefore, although over 60% of silver demand is industrial, that demand seems to have a variable effect on the silver price. However, the correlation between silver and gold is actually very strong. This suggests that silver is priced more as a precious metal than as an industrial metal. We also know that it's not the physical investment demand that drives the price of precious metals, it's the paper derivatives. The silver market is small and volatile and has the highest derivatives to physical ratio of all commodities. This chart indicates that it would require 160 days of global production of silver to cover the short contracts for silver. For gold, it's only 90 days. So it's likely that the paper derivatives pricing of the metals has constrained the lows in the gold-silver ratio over the past 30 years, leading to the observed floor in the ratio. So a transition from paper to physical pricing of the metals has the potential to remove the floor in the ratio. Inflation expectations also influence the price of precious metals. Shown here is the inverted 10-year break-even inflation rate in blue, and the gold-silver ratio is shown in green. And we can see that as inflation expectations rise, that's signified by a drop in the blue line, then the gold-silver ratio drops. If we see significant inflation going forwards, particularly when it's felt at the retail level, then that's likely to break the floor in the ratio. We have already begun to see a substantial increase in investment demand for silver, and this has persisted despite the recent drop in the silver price. An increased preference for physical metals in conjunction with increased investment demand has the potential to alter the precious metals pricing mechanism, which could drive the gold-silver ratio through that floor. We have over 2 centuries of evidence showing that commodity prices are cyclical, and we've recently come off a historical cyclical low over here. This would suggest that commodity prices are likely to be on the rise in the coming years. But then what could spur this on? Well, we've got fiscal stimulus with spending on infrastructure, as well as things like the intended greening of the economy with renewable energy and electric vehicles. And silver is a crucial component for these things. How does this relate to the gold-silver ratio? Well, this chart shows the gold-silver ratio in green and the commodities to equities ratios in black. Previously, peaks in both ratios have coincided, but since 2012, as you can see here, the two have diverged very, very significantly. Commodities are currently at historically low prices relative to equities, and so the downside seems very limited. If we are at the start of a commodity supercycle, and both the industrial demand and the price of silver rises as part of that supercycle, particularly in the face of physical silver supply shortages, that could break the floor in the ratio. Returning to the gold-silver ratio chart we saw earlier, if we anticipate that the financial environment of the past 30 years is likely to persist, then I suspect the ratio is likely to bounce off of this floor and go back up towards the 80 level. But if we had a sustained break of that floor, I think that would signify significant changes in the financial and economic landscape. In conclusion, the current gold-silver ratio suggests that the precious metals are in a secular bull market. Due to its tendency to mean revert, the gold-silver ratio seems to have further to fall, suggesting that silver is favoured over gold. Before reaching its ultimate low, the ratio is likely to spend more time around the mean range, and I think that a historically low gold-silver ratio is possible. Now, the reason that I say that is that I think there are multiple drivers that could drive the ratio downwards in the years ahead. The paper pricing of the metals appears to have been put under pressure recently as a result of increased demand for physical delivery. If the paper pricing is supplanted by physical pricing, the gold-silver ratio is likely to fall. Regardless of whether or not the paper market breaks, I postulate that factors such as inflation, monetary demand, and industrial demand have the potential to act synergistically to bring the gold-silver ratio down to historically low levels. Note that none of this is meant to be a prediction. It's simply a discussion of the potential scenarios. If you believe that the financial environment that we've been in over the last 30 years or so is likely to continue, then yes, the gold-silver ratio is likely to stay within that floor and roof range that we showed in the previous chart. However, if we think that a change is going to occur in the financial environment, then we need to consider the possibility of a historically low gold-silver ratio. Next up, the market update. Let's start with gold priced in US dollars on the monthly scale, because of course another month has gone by and it's been a number of months since we've been in this downtrend, of course. So yeah, we're taking a kind of big picture view standing back, and we can see that this month we had a lovely green candle over here. Does that mean that we're out of woods? Look, not necessarily, but you know, the reasons why I'm positive are that we've been in this correction for quite some time now. I do still think it's a correction within a secular bull market, and we have quite a lot of support here. So you can see that price kind of stopped around this 1700 level, which fits with here where there's a lot of price bars here. And so this whole area should be reasonable support there. So that's not looking too bad. And, you know, if you stand back, I think that still looks like a smallish correction. And if you look back even before 2011 here, that's not too dissimilar from normal price action within bull markets. And if we zoom in, we'll look on the daily scale. So this is going back to the peak that we saw in August over here. And we've drawn this downsloping channel here. And we've had 3 tests of this channel, one here, and one here. And I'm thinking that this is the last test. Often with these things, 3 is a common number for these things. Not sure why, but price has been moving upwards again. So we are in a short-term uptrend. And remember last week, I was saying how, you know, it's possible that we come back to retest the 1760-ish level, which we have done. So this isn't anything unusual. It's nothing that bothers me particularly. And I still think we're moving up towards this upper trend line. Of course, what happens here is going to be quite crucial. Could we come back down here and make another new low down at, you know, below 1640? It's possible, but I think it's the lower probability option here. But yeah, only the market will tell us what is the correct thing here. So yeah, we're looking for around the 1860 level. And now if we do get above that, then the next really important area to negotiate will be this one here, which is 1960. So, you know, we could possibly move up, might spend a bit of time here before coming through. But when we get there, you know, there is a chance we could come back down here and retest that before making another move upwards. But look, let's cross that bridge when we come to it. We still don't know what's going to happen up here. But yeah, as I said, I think this price action seems to be quite reasonable. And it's, you know, it's a gentle downslope over here as well. And I want to just look at gold price in New Zealand dollars, just because it's quite interesting in that, again, we've got this downsloping trend line here, and we've had 3 touches of it, and it seems to be hanging around in this area for quite some time. So if we do get a break, and particularly if price stays above 2,500 over here, then I would consider that as a breakout. So, you know, that could be quite promising. Is that an early sign? Of course, the problem with these things is the exchange rate. So that does influence things. So what happens here doesn't necessarily equate to what's going to happen in the US dollar. So just something to watch out for over there. But I think this is looking quite positive over here. And we'll move on to silver in US dollars. And again, we're going to zoom out, look on the monthly scale. And this doesn't look too bad either, does it? You know, we've got a nice green candle here. And this price action, you know, seems to be fitting with a consolidation over here. And it's not unexpected. So if we look back here, you may remember that I mentioned quite a few times in the past how this is going to present us with a problem, and it has done so. And so until we negotiate this, I think prices are going to stay in this kind of area for a little while. But look, let's zoom in a little bit and look on the daily scale. And price broke out of this descending wedge-shaped pattern, and we're hanging around this 26-ish level. And again, that wasn't unexpected. We had talked about that because of this area here, and of course previously as well, that had been an area of resistance. And you might say, oh, well, this has been doing this for quite some time now. But then, you know, I mean, this took 8 trading days here before it picked a direction. And it's been about 8 trading days here. So we're really just waiting for it to pick a direction. If it comes back up into this area here, I'd expect the 26 to become support. And as I said, this pattern is bullish, so I think it is going to make its way up there. It's just going to take some time. So as with all things related to precious metals, patience is crucial. Now, I just wanted to revisit this chart, and some of you may remember my market report from the 7th of February. If you haven't seen that, go back and take a look at that for more details. But the gist of it is that not just in silver, but in a few other unrelated asset classes, I've noticed repeating patterns within, you know, certain time frames. And so we talked about that in that market report. And so the price action that was over here, but on the daily scale, was formed into bars, and then I pasted it onto silver on the weekly scale. And so this was the result. And we're talking about whether this was going to be predictive. And look, I have absolutely no idea whether it is going to work or not, but this channel's about coming up with ideas. That's all it is. I'm not here to tell you that I know what the price is going to do, because I don't. So this is just simply an idea to play around with. And as I said, I've noticed this in other asset classes that have nothing to do with silver or gold. And so this is why I just wanted to try it out. And of course, with any method within technical analysis, there are flaws, and I haven't found an exception to that yet. So what are the flaws with this? Well, what you'll notice is that when I pasted this in last time, I'd actually put this high over here. And that's the thing, when you paste these bars, it's adjustable. But the thing is, it's adjustable in 2 dimensions. So you can adjust it in terms of its height, and so that's going to affect the price. But you also adjust it in terms of its width, which basically adjusts the time span. And so because we'd hit this high there, I'd kind of just put that high over here, which basically shortened the time span. But now I'm thinking, oh, maybe that's not quite right. So I've readjusted it. And look, this was that time where they had that Wall Street bets silver squeeze thing. And, you know, I think it'd be quite valid to call that a potential anomaly. And certainly in other charts, it kind of messes up quite a lot of other charts. But if we work on that being an anomaly, then this could still be valid. Now, the other things to note are that this isn't something that's exact. And so with the other examples that I'd looked at, it wasn't that this told you exactly where the price was going to be. It just told you about the general trajectory of price. Yeah. So it doesn't tell you when the low is going to happen. And as I said, if you're doing it prospectively, you have to adjust in those 2 dimensions, and you don't know whether you've made that adjustment correctly or not. So I'm doing this as we go along. And as I said, I've readjusted this and we'll see. But look, so far, this is suggesting here that in the next kind of 2 weeks or so, we could go back up to 30, but then it's going to get smashed back down to maybe 27, 26-ish before resuming upwards. Let's see if that's correct. Again, it's all dependent on how I've structured this, how I've adjusted this, and we may well need to adjust it again. And it may be completely wrong, you know, in which case we can chuck it out of the window if that's the case. Okay, let's move on to the gold miners. So this is the GDX on the daily scale. And we had what appeared to be a clear breakout over here. And I was talking about how price could likely come back down, retest before resuming upwards. But it went actually below that line. So the question is this a false breakout or is it real? Now, what you'll notice here is that we've come back and looks like if this is indeed a double bottom, then we're retesting the top of that there. So kind of the major bars are actually a little bit lower than the top of the candles here. So around here. So, you know, ideally we'd want to see a turnaround over here and go back in an uptrend. There is potential for a bit more downside though, and we do have some support over here. and here, if we were to work on this trend line over here. But yeah, this is a tricky one. I still think that this 31, 32 level is strong support. So I don't think we're going to go back down through there and breach that. I'm still positive about both the metals and the miners. So I think we are going to get a turnaround again. Just not sure exactly where that turnaround is going to occur. Now let's zoom out and look on the monthly scale. And again, this just looks like a correction, and we bounced off of that support over here. And I think, as I said, I think we're going to resume the uptrend and continue up here. And that would give us a target of around 55. And I think that would be strong resistance here. It was resistance over here, and we got a lot of price action over here. Sometimes you can get a bit of an overshoot. If that happens, then you're going to get even more of a smackdown if that occurs there. And there's another one there that suggests that that's a reasonable target. But yeah, that's the model that I'm working on over here. And interestingly, if you look here, again, if we ignore this as an anomaly and just look at kind of where the bulk of the candle finishes here, we've got quite a nice curve here. So that's what I'm working on anyway. I'm still positive. And again, we've got the junior miners, so the SILJ, and this probably wins the prize for the most boring price action around. It's pretty boring, and most of the time seems to be spent between that 15 and 16 area. Remember, we've got a gap here. So whether that gap's going to get filled, I'm not sure, but I'm not worried until we breach this lower trend line. That's when I'd start to change my tune a bit there, but I don't think that's going to happen. So have we got more downside? Well, there is potential if that gap is going to close. It doesn't have to close, but yeah, that is potential. But I would expect price to turn around from there. How long are we going to stay in this kind of consolidation though? I mean, who knows? It will take its time, but I think when it moves, it's going to move fast and move quite sharply. So, you know, that's something that I don't really want to miss as well. But yeah, overall, I think just a bit more sideways movement with this until the important level here seems to be just over the 16 level. So that seems to be where most of the price seems to get stuck. We've had occasional pokes up above that. So once we get sustained price action above that level, then that's going to be a bit more hopeful. That's it from me for this week. Don't forget to like and subscribe, and we will see you next week. All the best. Bye.